Welcome to Stocks to Watch, where we talk with experts to help you navigate financial markets. I am Moneer Barazi, your business analyst and host, and joining me today is Don Durrett. He is a seasoned gold and silver mining analyst, author, and founder of goldstockdata.com, a leading platform providing research, ratings, and data on over 800 precious metals companies. Hello, Don. It's good to have you with us today.
Yeah, Moneer, first time. I'm ready.
Yeah, I'm happy to be here really and have this discussion with you. There's a lot happening. I'm sure you saw that gold dropped from its peak at around 4,360, I believe, and today is trading around 4,000, slightly lower, higher. I'm not sure. So is this a profit-taking round or is this a maybe a longer term correction? What is your view on what is happening?
Before we continue, be sure to subscribe to our channel and ring the bell to get notified about our latest videos.
Well, it's Monday, October 27th, and we corrected. It wasn't last week, it was the week before where we went down $300 in a single. I think it was up 350 and then it went down 200 in one day. I think it was 250. But then last week it continued to correct, and now Monday it's continued to correct. So gold is down 8.5% from the top. Silver's down 13, and the HUI, which is the miners index, is down 18. So most people also invest in juniors. So most people's portfolios are down more than 20%. Some people are probably down 30, depending on how aggressive they were. So a lot of people are thinking, you know, is this a time to, it's a scary time for it. This is when you have to kind of ride the train, and you have to, if you're not a trader, if you're in a bull market, I don't think that trading really, it's kind of difficult because you don't know when these things are going to turn around, when to get out, when to get in. I always like to use the example, the S&P 500 in 2008, it went to 666. If you got in at 666 and then you just rode it, you have like a nine bagger, there is no real reason to trade it if you're getting those kind of returns. Whereas the people that trade it, sometimes it gets away from you, and you wait to get back in. But in this particular one, the people that traded it did well. So I mean, because we had this parabolic move, and people jumped out at 4,200, 4,300, and now they're like, oh man, this is great. I got out of the way. Now it's time for me to get back in. But now they're like, uh-oh, when do I get back in, right? So do they give it and do it back in? Now it's always difficult to know when to get back in. That's why I always say, and if it is a bull market, you're going to have higher highs, not lower lows. So we're at 4,000. Once this correction's over, that the odds are we're going to go back above. I think it was around 4,350. We'll get a new high. I don't think we got to 4,400. So if you're getting higher highs, I always say just ride the bull and buy the dip. So I actually bought shares last week. I bought the dip. Now this is another buy the dip. Today's another really good buy the dip opportunity. We'll see how it goes. I thought that gold would not go down below 10%, so we're down 8.5. I think this correction is just about over. As a matter of fact, I think Friday, by the end of this week, I think we're probably going to get a good idea of how, if this correction's over, if it's going lower. Now, I'm very bullish gold and silver. I think we're in a bull market. I think it started in August. That was when silver broke out above 40. Now let's see if 40 holds. So we're at 46, almost 47. I do think 40 will hold. I think my cycle low is 42 target, about 3,700 on gold. So it's possible that we could go a little low here. Now, for me, I don't think this is the deep correction. I think the deep correction is when the S&P 500 finally rolls over. And the S&P 500 is at 6801, and the all-time high was 6807 on Friday. So S&P's at an all-time high today, which is amazing. And I've said that S&P and gold are correlated. So if the S&P doesn't correct the next 2 weeks, I mean, gold will turn around and go back up. We'll see what happens. But when the S&P does roll over, I think those lows that I'm looking at could get tested, 42 on silver and 3,700 on gold. So there's still, I think there's some downside risk here, but I just prefer to buy the dips.
Yeah, it is a wise approach, and the longer term trend is definitely bullish from where I'm standing. And of course, it's always a question about how to time the market and whether you get it right. You can definitely try to buy the dip now, and it could drop lower and then go back up. Uh, it's definitely a good exercise to try to time the market, but not everybody gets it right. And I know that your longer term view on gold is generally bullish, besides silver. And I'm glad you mentioned the correlation with S&P 500. So if I could ask you about where do we go from here? Let's talk about perhaps 2026. Where do you see gold and silver, and even the main indices like Standard and Poor's 500, Nasdaq, Dow Jones? Where do you see them heading?
Yeah, you kind of gave me a softball question there, but it's great. So what's going to happen, in my opinion, is that we're going to get a recession, and there's nothing they can do to stop it. It's like the economy is slowing. Everybody seems to think that next year that we're not going to get a recession. The business cycle went away, and that we're just going to keep growing, growing, growing. But this business cycle has been extended through manipulation by the Fed. They manipulated the 2008 recession. They didn't allow companies to fail. They just printed, and just created all this liquidity. They basically used the Japanese MMT approach of modern monetary theory, where you just print money and create liquidity, lower rates, and don't let a recession occur. But what they did, and then they took rates to zero during growth. It's like history rhyming. So Reagan in the 80s, he used Keynesian economics, deficit spending, when we were growing at 3, 4%, 5%. And he kind of broke, the capitalism, if you will. And now we're kind of doing the same thing. It's kind of history's rhyming, where we're printing money when we have growth. Kind of the same thing. And you're creating these bubbles, but what we've done is we've let it, like a cancer underneath the system, kind of create. It's like this slow bleed, and we have this unbelievable damage that's been done to the economy because we've been manipulating it. We didn't let the economy reset in 2008, which we should have done. We should have had like a 2-year recession where a lot of people lost their jobs, and you kind of reset the system. We didn't do that. It was a 9-month recession. Very few people lost their jobs. We're back in growth. We've been growing since 2009, and the cycles don't go away. And kind of the old timers, if you look at the old timers, they know these things don't go away. Warren Buffett, he's like $350 billion in cash, which is he's like, he knows it's coming. Jim Rogers is like, he said, be very, very nervous, very concerned. He's like, the business cycle didn't end. Stanley Druckenmiller's the same. He's like, he's nervous. Jeremy Grantham's my favorite. He says this is the most vulnerable market he's ever seen. So the old timers are like, look out below kind of thing. And I agree. So basically, I don't think we can prevent a recession. And so all we're doing now is waiting for it. And I believe that gold is the canary that's telling you, look out, people, look out. It's like, because gold, even though gold's correcting here, normally everybody's getting kind of tricked, if you will. Normally, if gold's going down, that means that's good news. Right?
Right.
It's like, that's
Right.
good news. Gold's going down. Nobody wants
Right.
gold. Good news. That means the economy is going up. It's a total head fake, because gold is just doing a little correction here, because it's up. I didn't do the numbers for the year, but it's up over 50% for the year, over 50. It's leading. And so this is just a little correction, and it's going to go higher. Now you asked me about the markets. So I think the market's going to top here soon. Maybe this quarter, maybe the first quarter next year. It is going to top it, I believe. It is going to top. And when it does top, that's going to be really good for gold, really good for the miners. The reason why is because that money will rotate. First of all, it'll create a fear trade. And so it's ironic that gold has been ripping and we don't even have a fear trade. Now, what is a fear trade? A fear trade is when nobody wants to own the S&P 500. It's like, I'm not touching stocks. You're in stocks? I'm not touching stocks. That's a fear trade. It's like nobody's in there. The only people, and so we're not in a fear trade. So fear trade starts, that's when money comes out of the S&P. And when it comes out in the S&P, then they have to figure out where they're going to put their money. They're going to put it in money market funds in a bank, right? They're going to might buy treasuries, short-term treasuries, might do ETFs there. They might be buy foreign stocks as a possibility. They might buy gold and silver, of course, and they might buy the miners. But we're talking about trillions of dollars, and gold and silver mining stocks is a tiny little portion. It's less than $1 trillion total for the gold and silver miners. And so it's really easy for them, a little bit of rotation. If the stock market goes down and the money starts rotating out, it's really easy for the miners to get a bid, if you will. So right now, the miners are undervalued. If you look at like Newmont, if you look at the free cash flow multiple, Wall Street hasn't been playing here. So gold's been ran from 2,000 to 4,000. Wall Street's still not interested. So you have these very low valuations in these miners. They should be 50% higher based on the free cash flow. So that's what I'm looking for. That's why I know we're early innings. It's like, so in regular stocks, you look at the PEs, and the PEs are about 22, 23 forward earnings, which is historical highs. I mean, it should be about 18 is kind of the norm. So they're like 25% too high. And miners, I prefer free cash flow multiples instead of PE.
So in a way, the way you're describing it is that the Fed is putting the economy on opioids to avoid an inevitable pain. As we have seen throughout history, those cycles of, I don't know if you can call them booms and busts, but perhaps a bust is coming, the way you're describing it. And the signs are there, especially the gold prices. They're indicating that investors are worried about something. They just don't know what it is yet, in a way. So that's definitely a good caution sign. And another sign of perhaps worry, perhaps not. I'll leave that to you, but trade policy and Trump's fascination with tariffs. You've heard about his desire to impose 100% tariffs on China, and then there was a proposed meeting with the Chinese President Xi, and then I'm not sure what happened after that, but there's this back and forth around trade policy. Do you believe that risk is already behind us? Is it priced in? How do you navigate trade policy when it comes to investing in mining companies?
Right. This is where it's really difficult for people to kind of understand the big picture, if you will. And so you kind of, the mainstream media is, and the business world is kind of determined by what's going on Wall Street. In other words, Wall Street gets to determine the narrative. Those are the guys that get on TV. But those guys, their culture has to be positive. So their culture is all around, I mean, their customers are investors. You don't want to tell investors about the negatives, all the red flags. That's less money going to flow in. So you got to talk your book, and you got to basically say, look, you have to look at the positive. You have to look at GDPs. You focus on GDPs. GDPs are 3%. Well, guess what? GDP is an illusion because they count government spending. So we have $2 trillion of deficit spending. If you take that out, we don't have any growth. So, or very little. So you can't really count GDP. And then if you look at CPI numbers, they're kind of under. They say that we're around 3%. It's a little higher than that because the government has manipulated the numbers. If you go back and use the numbers we used to use, it's a lot higher. And the reason why the government changed those CPI is because for their benefit, the higher the CPI, the more that they have to spend, like on Social Security every year. So CPI. Then if you look at earnings, that's another one they like to look at. And if you look at earnings, most of the earnings is coming from the Mag 7. If you take the Mag 7 out, you look at the other 493 companies, it was under 3% last quarter. That's not strong growth. A big chunk of those companies aren't even making money. And that's just so they're looking at those numbers and they're ignoring everything else that's happening. And if you start looking at everything else that's happening, you start to get nervous. Something fundamentally changed when the Ukraine war started. And what that fundamentally changed, the first thing that changed was Western Europe, because Germany, which was the engine of Europe, and now they have high energy prices. And if you look at Germany's GDP, I mean, it's been flat since that war started, and they're not getting their cheap energy back. And that was the engine of Europe. So Europe's economy is basically kind of flatlined, which impacts the entire world's economy. Then, if you look at what that war did to the trade policy, which you mentioned, it damaged for the U.S. It damaged it severely because prior to that war, U.S. global hegemony was really, really solid. I mean, you can equate it to, let's say, a New York crime family in New York was like in complete control. Let's say half the city, right? And everything's rosy, and they're just nobody messes with them. They own half the city, right? And that's kind of how it was prior to the Ukraine war. Everything's fine. Well, basically what happened is when the Ukraine war is that we kind of flipped the whole thing, and there's so suddenly that family they no longer control it. Now they're basically just we got this mob wars going on, and the apple cart got completely tossed, right? And now it's just complete confusion about who controls what, right? It's just complete confusion. Well, that's what's happened here, and everybody's in denial. Everybody's in denial that the apple cart got upset. But when that war started, the international trade apple cart got completely upset, and to the degradation of the United States. Because prior to that, we controlled pretty much the entire world as far as trade policy goes. The dollar was the reserve currency. The U.S. Treasury was the reserve, and the SWIFT system, where all trade was done in dollars, was that way. The U.S. was we were total control, basically, of international trade policy. But when that war started, now you had Russia and China. Prior to the war, were basically antagonistic. After that war started, now they're buddy-buddy. China and India were basically antagonistic. Now they're buddy-buddy. And then you got China, India, and Russia, triumvirate, who are basically all buddy-buddy. All three of those countries are working together to basically create an economic hub of half of the world, the global south. That all started out of the BRICS. That is detrimental to the U.S. economy, and everybody's in denial. They're like, that's okay. Everything's the same. Nothing changed. Something did change, but nobody really realizes it yet because the mainstream media doesn't talk about it. The mainstream media talks as if, global dominance, global supremacy, is still in place. So that was major, huge shift. Now, it was inevitable, if you will, that the U.S. was going to lose its global hegemony. It was just a matter of time because we were slowly going broke. But the Ukraine war sped it all up. And so now we're in a position where when we do go into a recession, which I think is inevitable, the Fed is going to be like pushing on a string, trying to restart it. And this is when everything breaks. This is when gold goes to the moon. This is Pierre Lassonde said that the gold's going to go to 17,000 by the end of the decade. And that's what he's talking about. He's basically talking about this resetting of the whole global trade system and resetting of who uses treasuries, who holds dollars. This whole thing, this is all in a flux, and this is the reason why gold's going higher, and this is the reason why this correction to 4,000 is just a correction and a buying opportunity because of what I'm explaining about. You look at the whole picture. Now, I haven't even really went into the weak areas of the U.S. economy that everybody's in denial of, but the tariffs are making things worse. Buy a car, it's going to become more expensive. Housing materials more expensive, and Trump's not going to back off that, and he's going to be in office for another 2 years. So all those tariffs are going to stay in place. And I've been saying this, that everybody was calling Trump taco. Trump always chickens out. And I'm like, no, he's not. This was before we basically got that coalesce at 15%. I said, he's not backing down. We're going to have high tariffs. 15%, and that's what we have. And I was right about that. 15% tariff that's a high tariff. That's the average 15. And if you think that this Chinese trade war went away, it didn't go away. They're not going to have, there's no kumbaya here. There's antagonism between us and China, and that antagonism isn't going away. The U.S. is trying to maintain its global hegemony, and China is not in that same camp. We have an economic war going on right now between the U.S., China, and the BRICS, and Russia and India. An economic war, and everybody's in denial. And this is all going to blow up, if you will, when the stock market finally starts going down. Wall Street's in complete denial of what's coming. It's a bulldozer, and there's nothing going to stop it.
I can see many signs of concern, like the U.S. debt. Although I would argue that the U.S. debt is relatively small when compared to debts in other countries, like Japan, for example. Even though they might be implementing similar policies now, those Keynesian policies, don't you believe that there are some resilience factors in the U.S. economy still, despite all of this?
No, I don't. I actually believe that I said earlier that there's nothing going to stop the recession. So if there was resiliency factors, then I would say there's a possibility we're not going to get a recession. I don't see that possibility. I see it as a fait accompli, and it's not that far out. Now, you said that debt was somewhat manageable. I would disagree there.
Say that. I just said that it's relatively small.
You compared it to Japan and you compared to Japan and basically said that we don't have the highest debt. So, but that doesn't mean it's manageable. So what if somebody else has a higher debt? The issue is a lot of those countries, they manage their debt internally, right? Japan, they manage it. We do not. We do not manage it internally. We manage it. We've been exporting debt since the 1980s. That's what we do. We export debt. And if we can't export our debt, we're done. And this is the reason I own gold and silver mining stocks. It's the very reason. It's the reason I got into it, is that eventually the U.S. goes bankrupt because the rest of the world recognizes that we're kind of screwed. Once we start exporting inflation, which is kind of what we're doing, when you export that debt and then you have inflation, those bonds go down in value. So you're a fool to buy them. And now more people are like, I'm not buying those bonds. China stopped, and people don't know this. China stopped buying our bonds on a net basis in 2013. So if you look at they had 1.5 trillion in bonds in 2013, and it steadily went down, and now it's 750 billion. They've sold half of their bonds over 11, 12 years. And they basically realized that a long time ago, the U.S. is screwed. We're going to start slowly selling our bonds. And Japan hasn't started doing that, but they will. And Japan's the second biggest. And foreigners are going to, this is starting now, but it's going to get worse. It's going to get to the point where no foreigner wants to buy our bonds. Once it becomes, so I can see it now, but more and more people are going to start, it's going to become very, very obvious, the end game here. It's going to become very obvious. The Russians have been saying this. That the U.S. is going to try to use these stable bonds to devalue the dollar and basically, pay their debt off that way, devalue everything, right? And they're right. I mean, that's kind of what we're going to end up doing. We're going to end up doing kind of a quasi default, not 100% default, but like 30%, 40% on our debt. And that's kind of our only way out here. And once people start to realize that that's the end game here, it's going to be really hard for us to export our debt. And so this is when it becomes unmanageable. Now we have right now our interest payments have tripled since 2020. We used to have 300 to 350 billion dollar interest payments. Now we're at 1.1 trillion dollars in interest payments. So interest payments tripled. It's not our number one expense, but very close. Defense is like under $1 trillion, but I think the Medicare, Medicaid is over it. But it's above it. It's over $1 trillion just in interest alone. So
yes,
and if we go into recession, and we're not going to be able to get those long-term rates down, so they're going to keep borrowing on the short end. If you borrow on the short end, you have to keep rolling them over. Like this year, we had to, if you go on one of your AI programs and you ask how much money the Treasury had to borrow this year for both new debt and rollover debt, it's like $9 trillion. $9 trillion, that's how much they had to borrow. And it doesn't show that up because they considered it an asset when when a bond's outstanding, they consider it an asset. So when they borrow the money and they pay it off, it doesn't look like the debt went up because they're offsetting it, but they did have to borrow it. That's how they roll over those bonds. And so now they're rolling over these massive amounts, which is going to continue happening. Because a lot of this money that they're buying, when they borrow it, they're borrowing on the short end. So they borrowed a lot of money on the short end. So that in those interest payments it's not going down much over the next 2 years. So then we go into a recession. We go into recession. The way recessions work in the United States is the government is on the hook for helping the states out. So whenever you have a recession, the deficit goes up. You can go back and look at it in history. And the reason why it goes up because the US is on the hook. They have to give the states money. They can't basically tell the states go, we need more money for this program, because those programs are kind of guarantees, if you will. So as the program needs more money, the government has to fork it out, if you will. Now, Trump, he tries to find, new ways to do things. He might tell the states, sorry, we don't have the money, but the deficit's still going up if we have a recession. So we're at 2 trillion right now. If we have a recession, you're looking at 2.5, maybe higher, but I'm thinking 2.3, 2.5. Well, you get to 2.4, do the math. 2.4 trillion divided by 12 is $200 billion a month that they have to borrow. And the rollover debt, they have to borrow that too. Now, where's that liquidity going to come from? Where's that money going to come from? The whole thing is a big, big mess. And everybody's in denial that we can just keep kicking the can. The wall's right in front of us. And once we kick the can and hit the wall, it's over.
All right. So how do you prepare for this scenario? I assume you want to own mining stocks because you're bullish on gold and silver. Let's talk a bit more about your approach. How do you look, for example, first at the geographic jurisdiction? Do you look at the fundamentals? How do you search for good investment opportunities in this space?
That's a big question. I'd rather stick with what your opening comments is that, okay, if this mess is coming, where do you hide? Where do you go?
Yeah.
Right. And so one of the places that people can go, first thing they're going to do is they're going to sell their stocks when this all happens, right? So stock market's going to be, the fear trade's going to kick in. First thing that they're going to do is they're probably going to go to money market funds. A lot of people go to money market funds. Some people will go to bond funds. Some people, like the big corporations, they'll buy short-term treasuries, kind of what Buffett's doing. And so a lot of people will run there. A lot of people will go to emerging markets if they're doing okay. But if the US goes into recession, the rest of the world goes into recession too. So that's not going to be a good place. Some people will go to physical, but that'll be on the margin. And then the commodities, a lot of people are going to start thinking in terms of commodities because commodities are kind of in a down cycle right now. And so a lot of people are going to oil and gas because they're really cheap, trying to buy the bottom. So a lot of people go into commodities as well. But I'm actually negative commodities because I think that this recession is going to be a lot harsher than people think. And so even though commodities will go up in price, if you're owning a company, I don't see a lot of production growth. They might have some revenue growth, but on the whole, they're not going to outdo the gold and silver miners because the gold and silver miners are the sweet spot. And the reason why there's a sweet spot is because they have unbelievable leverage, just enormous leverage. So if you look at Newmont right now, their run rate at $4,000 gold is between 2 and 2.5 billion per quarter. So we're looking at $9 to $10 billion per year in free cash flow for Newmont, and their debt is 5.6. So once they pay off that debt, all that money that comes in is going to go back to shareholders in the way of buybacks and dividends. So they're going to be able to pay back that debt by mid next year if they want to. but I think they'll pay it back next year if we stay above 4,000. So by the end of next year, Newmont's going to have zero debt on their balance sheet. Now I'm just using one company. Most of these miners are going to be in the same situation where they can pay off their debt in 1 year. So we're going to have companies that have pristine balance sheets with huge free cash flow coming in, and there's no way in heck that investors aren't going to notice that and start pushing these things higher. That's why the multiples are going to expand. I think the multiples right now is around 8 for producers. I think they're going to go in the high teens, which is double. So the stocks are half off right now, and potentially could get in the low 20s, which happened in 1980. Average was 22. I think we're going to get somewhere between 18 and 22 in this bull market. So that's the leverage you have, and people are going to notice it. People are going to go into the miners, so that's going to be a really good place to hide. Now, the problem with miners is they're very volatile. So a lot of people came into this market in August and bought the top here, and the bull just definitely is, bucking and rug pulling them. There's a lot of people right now, their portfolios are down, 20, 25, 30%. I'm up about 150% because I got in early. And so this correction for me is like kind of a nothing burger. It's like, all right, I've been doing this for a long time. These don't bother me at all, and I just buy these dips. But the people that got in early, they're definitely getting challenged here. And you have to have conviction, and you have to recognize you're speculating. We're going after baggers here. 1, 2, 3, 4, 5, plus baggers. Baggers 100% return. But going after baggers, you don't get those without taking a risk. So people took a risk in August, September. They took a risk. They thought, oh, this is a slam dunk. Gold's going higher. And now they look at their portfolio and they're down 20, 25%. Some people 30. And they're like, oh my goodness. I mean, can you imagine you put 100 grand in and you're sitting at 66,000? I mean, ouch, right? So, and now people are like, do I jump off the train? Is it going lower? Can I handle this? Especially if it's like their life savings, like, can I really stay on this train? Don says that the odds are great, are very good that this thing's going to turn around. We're going to get higher highs, but I don't know if I can handle this. And so a lot of people will jump off the train, and they're like, I don't want these miners. I can't, it's not for me, kind of thing. So I guess I'll stop there.
My last question is to you, which is a follow-up to what you just said. You mentioned that people who bought back in September, they struggled. The portfolios had a drawdown. So in your case, how often do you rebalance your portfolio? How long do you hold your positions?
That's a good question. I answered this question yesterday to somebody because somebody said, don't you continuously rebalance, right?
Yeah.
And so there's kind of 3 ways to do this. Number one is to be active trader. If you're an active trader, if that's your personality, but in order to be an active trader, you have to basically monitor and manage your portfolio on a daily basis. And not everybody psychologically can do that. I can't. I don't like the emotion of trying to manage a portfolio on a daily basis. And then the other one is rebalance. There's 2 others. The one is buy and hold, which is what I do, and the other one is more aggressive rebalance. And you can have a combination of all 3. And I know a lot of people that do kind of aggressive rebalancing. Stock goes up, they take profits, they put it here. They're constant rebalancing. And those are like quasi traders. And the more quasi they are, the more rebalancing they'll do. Me, I'm more of a buy and hold guy. So what I do is I don't do high allocations. It's really difficult for a company to get more than 1% in my portfolio. Really difficult. So I'm more of a 0.5 to 1% guy. And so I don't try to pick winners. Even though there's stocks that I absolutely love, I don't say, oh my God, I love that stock, I'm going to put 2, 3, 4% in it. I don't do that. I just do 1%, and then I let the winners appear. And so what I do is I kind of cull the herd. So I buy and hold, but I will, once I see a stock, I call it changing the story. Once the story, so I buy a stock for a reason. And if the story changes, then I'm apt to sell it. It's like, okay, I call it kind of culling the herd. So I'll sell that stock. Like I also call them dogs. So the stocks that get culled are the dogs. So I'm down to 3 dogs in my portfolio, and I have 161 stocks. So I've been calling the herd. I actually sold 4 stocks that I consider dogs last week. And I took those 4 because the reason why was because Ascot Mining. Ascot Mining was a stock that I was holding on to see exactly, what was going to happen here. Are they going to go bankrupt? Are they going to get back on their feet? I had a really bad feeling. My gut told me to sell that thing, but I held it. And then they announced 150 million raise at Canadian at 1 cent Canadian. I mean, just a total rug pull on shareholders. So I decided, okay, that one's got to go. And then I decided if I'm going to sell that one, somebody on Twitter, they mentioned another stock and asked me if they should sell it. And it's been a bit of a dog. And I said, yeah, let's go ahead and sell it. I'm gonna sell Ascot. I might as well sell that one too. So I sold those 2, and then I sold 2 others. So I called the herd. I sold 4 stocks that basically dogs that I don't think are going to turn around, and then I put that money into stocks that I'm under allocated. So I will redo that, but I usually only do it on stocks where the story changes.
Yeah, that definitely makes sense. Buy and hold when it comes to the ones with good fundamentals, and when you see a shift in the story, as you mentioned, you can let go of the dogs, which are in a way unavoidable in a portfolio. You're always going to end up with a few dogs, but it's the baggers that usually compensate for everything. Thank you so much for all of those insights. That was a lot to digest. Don Durrett, the analyst and founder of Gold Stock Data. I'm sure that was very useful and helpful to our viewers. Thank you very much, and I hope to see you again very soon on this show.
All right. Thanks, Moneer. It was fun.